everyone, and welcome to a new RRG video for this week on Thursday the 13th. Interesting week again. Last week obviously very weak for the S&P 500 and various sectors, and the same is happening today. Another weak day when I'm recording this. Nasdaq's down about 2%, S&P 1.5%. We're going to look at sector rotation and see where we are, and then dive into the individual members of one sector in particular. Let's get started. When I start at the weekly relative rotation graph for the 11 sectors, then it's a pretty interesting picture and a pretty interesting rotation, because you know that I like to look at RRG heading, which is the heading of the tails, measuring the direction of the tail from the previous node to the current node. So basically for the energy sector, it would be from this is last week, and this node is this week. It's a weekly RRG. And just for your information, people ask that sometimes. This is up to date until the last price. So this is last Friday, and this segment is fluid until this week, Friday's close. Now, on a weekly RRG, you won't see a lot of changes there, so it's pretty reliable that we are still in what I call a positive RRG heading. And when you look at the heading for all the sectors, 9 out of 11 are at a positive heading. Only tech and consumer discretionary are at a negative heading, moving into that southwestern direction, and we like northeast. So this whole cluster of blue tails inside the improving quadrant are at a positive heading. Financials are at a positive heading. Communication services are at a positive heading. It's only discretionary and technology which are at a negative heading. So first of all, I think that tells you something about the underlying. It tells you that it's tech and consumer discretionary that are driving the market lower. And unfortunately, these are the two biggest sectors in terms of market capitalization. So it hurts the S&P. But if you look at the entire S&P 500, look at all the groups, then a lot of these are pretty much all of them are outperforming tech and consumer discretionary. Despite the fact that we see the market falling, it is driven by, and I'm not going to say the Mag 7 because there it's a little bit more, but not everything is as bad as it looks. Does that make sense? So I want to be aware that there are absolutely opportunities, and if there are not opportunities right now, I think we will see some opportunities coming up in the near future. I don't know whether that's going to be a week, 2 weeks, a month, but there will be opportunities, and they will very likely be in sectors outside of tech and discretionary. These are likely the very first ones to start showing strength. What I want to do for this occasion, because this is the one that we look at most of the time, but I have some saved bookmarks in my browser where I have RRGs saved that break down this universe into cyclical, offensive, defensive, and sensitive sectors. And you will see an interesting picture there as well. Let me start with large cyclical. So these are XLB, XLRE, XLF, and XLY. These are the offensive cyclical sectors. And look at them. So financials is really good. It's turning back up. This is one of the strongest rotations that you can get. And then you see real estate and you see materials. They're still on the left-hand side of the graph. So in a relative downtrend versus the S&P 500, but they're picking up and the tails are pretty long. So there's quite a bit of power behind that move. Financials are back inside the leading quadrant, and as they are completing this rotation, so leading, weakening, back into leading, completely on the right-hand side of the graph, that means that they are starting a new up leg in an already rising relative uptrend, or in a relative uptrend that's already established. The only cyclical sector that is moving down and relatively down is consumer discretionary. It's still inside weakening, but you can see how long this tail is. So there's a big move. There's a lot of power behind this move. But out of the cyclical sectors, out of the 4 cyclical sectors, only consumer discretionary is at the negative heading. And again, because it is such a big market capitalization, it has a drag on the S&P 500. It's a negative impact on the S&P 500. But under the hood, there's quite a few interesting sectors to look at. Now we can do the same for the defensive sectors, the large defensive sectors. And if you look at that, that's healthcare, staples, and utilities. These are all on a strong RRG heading. Now hang on, that's interesting. Offensive, defensive. You would expect, and in a normal situation, that is usually also the case, that when I do these breakdowns, you will 8 out of 10 times see all cyclical sectors moving in the same direction and all defensive sectors moving in the same direction, opposite of each other. So when cyclicals are doing well, defensives are usually doing not so well, and vice versa. And here we see that pretty much all defensive sectors are on the rise. Not a big surprise given the weakness in the S&P 500, but it is a surprise given the fact that 3 out of the 4 cyclical sectors are also on the rise on a relative basis. That's something that caught my eye. And then we have the third group, which is sort of making all the rest up, so completing the others. And that's the sensitive sectors. And here you see, again, a similar picture. These are sectors that are sensitive to economic developments. Energy, industrials, communication services, and then here is tech going against the tide here. So out of all these 3 groups, the majority of those tails is moving at a positive heading, is showing positive relative strength. It's all being dragged down by tech and consumer discretionary. Just wanted you to be aware of that. Also, it is all relative. So the fact that something is increasing in relative strength, picking up relative strength and showing a positive relative trend does not automatically mean that the price of that sector is also going up. That's a very important basic premise of a relative rotation graph. Just keep that in mind. So all in all, for the sectors as a whole, it's tech and discretionary that are driving the market lower, that are underperforming the S&P 500, and a lot of other sectors are doing really well. In my top 5, for which I will write an update either tomorrow or over the weekend, depends a little bit on how wild the volatility is and how certain I can be that the ranking will not change in the last couple of hours of trading. That is the sort of the cutoff point for me, whether I publish before the market closes or I wait until the market closes and I do it over the weekend, because sometimes the differences in the margins are so close that I just don't want to run the risk of writing a story and coming up with a ranking and then having to change that again or correct it because the last couple of hours of trading have shaken things up. It wouldn't be the first time. Anyway, S&P 500, sectors, tech and discretionary dragging the market down. Let's see what we can find in other terms or in other areas. As we've seen on the RRG for the sectors, the financial sector is, especially on the weekly RRG, showing a very nice and strong rotation, going from leading into weakening and now back into leading. And we know that that is a strong rotation. So for this week, I want to take a look at the individual members of the financial sector and see what's going on inside that sector. And that's a predefined group on the RRG page. If you go to groups and you scroll through US sectors, you will find XLF members. If you click that, it will open up the members, the RRG of the members of the financial sector. It'll use XLF as the benchmark. So we're not comparing to the S&P 500 anymore, but to the sector index. And because there's quite a few names in there, I don't want to show 10 points of history. It becomes a little bit messy. I want to show, let's go to 5, tale of 5. That makes a little bit more sense. It gives us a good view of what's going on in that sector. Now, I want to warn you for one thing. If you change that, currently it takes the days off the front of the slider. So it basically sets the cursor back 5 weeks. And that's a bit confusing. I find myself every time looking at something like, oh, this is really, really, really good. And then I look at the chart and I think that's not positioned there, and that's because it's there. So we're going to change that in the next update. It'll be changed. We'll be taking it from the front or from the back of the period. But for now, you need to remember that you need to slide it all the way to the back, and now you are current. And what we see here is that this is a pretty evenly spread out universe. This is what you would expect from a relative perspective. It's a bunch of underperformers, a bunch of outperformers. There's a little bit inside weakening. It's all over the place, which is normal. Now, just for fun, let's take a look at how this chart looks when we compare it to SPY. Now we got the visual for the financial sector against SPY, and I hope you agree with me that this is much more tilted to the right. There's a lot more green. The right-hand side of the graph is a lot busier than the left-hand side of the graph. And this indicates overall strength against SPY for financial stocks. And obviously, that's the reason why XLF is rotating the way it is rotating. So let's bring it back to the XLF benchmark. And now you see that stuff is back in the middle. We got spread out. And what I like to do here to sort of make up my mind is basically select the first line in the table and then just press arrow down and look at the tails here. So here, BK looking very strong. JP Morgan, not so much. AGG, CME, very nice tail. WTW, a little bit close to the benchmark, but we may have a look at the chart, or I will take a look at the chart. This is nothing. This is way too short of a tail. This is going in the wrong direction. I'm going to be interested when it starts to take up again, curl back up again. That could be interesting because it's got a very high RS ratio reading. It's the, look at the RS ratio. It's about 108. This is the strongest or the second strongest stock in this universe. So there's plenty of room for DFS to turn back up, but not yet. Here, APO, that's heading into the lagging quadrant. WFC, maybe when it starts to turn back up, and that goes for most of these tails. The shorter they are on the right-hand side, the better it is, because that means that they have better odds of turning back up again. Goldman Sachs, maybe it's a short tail, so it's still a relatively strong relative uptrend, very stable. FI, potentially, when it moves back into the leading quadrant. AXP, obviously not, moving towards lagging. Same for Schwab, SCHW. And then we go into the lagging quadrant, and these are pretty much all very, very weak stocks, weak rotations. Maybe this is a very early turn up. TRV as well, and here we've got AMP again. So this is all where you really don't want to be. This is actually very weak. This rotates back down, so that's the opposite of the XLF sector on the right hand side. It's a negative rotation. This is negative, and then we got, so this could be potentially a shopping list of stocks that are showing a possible turnaround situation where they start picking up relative strength versus their sector index, and that could be potentially interesting to look at. So AON, these are pretty nice. So Berkshire potentially, but also AON when they're still inside improving, but about to cross over into the leading quadrant. Those are potentially turnaround situations, and they're definitely worth a look. But that was all of it. I'm gonna take a quick look at some of the names that I jotted down and bring up the individual charts. So what I noted looking at the tails on the RRG and combining that with the price charts of the tails. So I look at the tails and then I bring in the price chart combined with the relative strength lines to figure out my opinion or come to a final conclusion. And doing that exercise and going through all these stocks, I noticed that it is primarily insurance-related stocks in various insurance industries. So you got life insurance, full line insurance, property casualty insurance, but like in general, the insurance stocks seem to stand out, as do investment services like exchanges. And there are a few stocks that I want to pick out and share with you, because we can't do all of them. That would take too long. And by the way, you need to do something yourself. I can't do it all for you. Joking. Anyway, so you get the idea. AJG, Gallagher, or the Gallagher. This is a very nice chart. This is a rhythm of higher highs and higher lows that's fully intact. I can totally see that this stock is now resting at support, previous high now acting as support. Relative strength has jumped. The RRG lines are moving higher. This stock stands out, within the background, the knowledge that the market is actually very weak. This stock stands out. That is what you want to have in your portfolio right now. Another one would be AON, which is also security related, security brokerage firm. And this broke out to new highs. And again, we see the setback, but it's resting at support. And look at the relative strength, how that turned around and is now starting to drag the RRG lines higher. AIG, also insurance related, coming out of that consolidation pattern, relative strength picking up, still insight improving because RS ratio is still below 100, RS momentum is above it. That's improving and they're moving in the right direction. They're both going higher. That means a positive RRG heading. And then, for example, the investment services, there's two stocks that stood out and you all know them because you're probably trading on them. And the first one is ICE Data Services. That's the company behind NYSE, Intercontinental Exchange Group. Breakout to new highs, holding up there. Look at how the relative strength is turning back up and dragging the RRG lines higher. It's a pretty strong chart. There's nothing wrong with this chart. If you would look at this chart in isolation without the fear of the weak chart of SPY that is clouding your judgment, this is a very fine chart. And the other one is CME, the Mercantile Exchange, the CME Group. This is a super strong chart. There's no problem at all. And look how it underperformed the better part of the year and then it started to bottom out. And now it's really accelerating. And if you look at where the relative strength lines, the RRG lines are right now, comparing it to where they can move or where they have moved in the past, there's plenty of upside for CME to move higher, to still move higher on a relative basis. Doesn't mean that this, I could come up with a scenario or a potential move that the S&P continues to fall. It will start dragging companies like ICE and CME down, but they will just not go as far down or as rapidly down as SPY. And that's when relative strength starts to rise. And that's when the RRG lines start to rise. So that is, insurance related stuff, investment services related stuff. And one that, we have to look at, that's Berkshire Hathaway, just because it's Berkshire. And look at that, you've got performance and you've got outperformance, and it hasn't done a lot for a long time and got criticized for that. But if you're just looking for stable returns, this is what you're looking for. Very nice long-term series of higher highs and higher lows, moving higher and higher, breaking to new highs, testing former resistance as support, bouncing off it, pulling relative strength higher. Anyway, I want to wrap it up here. Financials still doing pretty well. If you look inside financials, concentrate on insurance, various insurance groups, investment services, and Berkshire Hathaway is classified as reinsurance. So again, insurance related, I guess, is what we need to say. The bigger picture, technology and consumer discretionary on the downside, dragging the market down. It's the biggest market capitalization. We've got to sit this through, but from what I see under the hood, there's plenty of stuff that is starting to provide some counterweight to technology and discretionary. And we need to be on the lookout when this market is going to bottom out and which sectors and which stocks in those sectors are possible opportunities for the new leg higher. That's it for this week. Thank you for watching. As usual, share your comments and your feedback in the comments below this video, and I will try to respond as usual. I'm looking forward to seeing you again in a new video on RRG sometime next week.